Hello everybody, here is the answer to exercise number 6 for Unit 12 in AC201, and this one is on the consignment of inventory, which for consigned inventory you are transferring possession to somebody else to sell on your behalf, but you're not physically selling it to that other party. They're basically just the middleman between you and your customer. So on August 1st, Funcon Incorporated is going to ship 400 custom video game controllers to Hester Consignment. Under the terms of this contract, Hester is going to sell the controllers on Funcon's behalf, and they're going to do so at a price of $80 per controller. Well, why would Hester want to do this? And it's because they are going to get commission. See, in exchange for selling these goods, Hester is going to keep 10% of the sales price of each controller that they sell. The contract states that Hester will hold the amounts collected from the sale of these controllers until one of two situations happen. All of the units have been sold, or 3 months have passed. The consigner, in this case, Hester Consignment, they don't want to have inventory on their shelves that's not really moving, so usually there's a time period within these contracts where they say, all right, whatever's not sold by this point is coming back to you. And that's what's going to happen here. If after 3 months Hester Consignment still has unsold controllers remaining, they're going to return them to Funcon Inc. So on Funcon's books, let's start on August 1st, where they're going to consign 400 controllers to Hester and transfer the goods as consigned inventory on their account. You don't have to keep a separate inventory account for your consigned inventory, but a lot of companies do. It just helps you know what's in your possession at the time and what's in somebody else's possession. So we're going to put this into consigned inventory. Just a different type of inventory account, still an asset. And we have to need to take it off of one of the inventory accounts in our books. What type of controllers are we transferring? Well, they're definitely not a work in process. They are finished goods. So we're going to have to reduce our finished goods inventory by the amount of inventory that we are consigning to Hester Consignment. Well, how much is this going to be for? Well, it's going to be the number of units consigned times the basis per unit, which is how much we paid to manufacture each one of these controllers. So we're transferring 400 controllers to Hester. Each one of these controllers cost us, Funcon, $50 to manufacture. Therefore, these controllers, which are now consigning, would have been on our books for a total value of $20,000, and that's the amount we're going to take out of finished goods inventory and put in consigned inventory when we consign these controllers to Hester Consignment. And then periodically, during this 3-month life of this contract we have, Hester is going to collect these amounts. They're going to report to us what they've collected, but they're not going to actually transfer it until, again, 3 months have passed or all the controllers have been sold. So let's start on August 31st. On August 31st, the representative from Hester Consignment would call up Funcon and say, during the period, we sold 130 of those 400 controllers that you consigned us on your behalf. Well, they're holding on to the money until, again, all of the controllers are gone or 3 months have passed. But they sold them. At this point, they owe us something. And because they owe us something, we need to put a receivable on our books. And we're going to call that receivable due from consignee. It's just a different form of accounts receivable. Accounts receivable counts like money from the general public. This is a different kind of party, so we give it its own account like we did due from factor. We're going to call this one due from consignee. Well, there's something else that's going on here. Hester gets to keep 10% of the sales revenue generated from each one of these sales, which means we're not going to get our full normal $80 piece selling price that they're charging. That much isn't coming to us. Hester's going to keep a portion of that, and we're going to record that portion on our books as a commission expense. But the full amount, even though we're not the ones actually selling them, they're selling them on our behalf, so we still get to record the full amount as sales revenue. And for these ones, the best way to do these journal entries is to work from the bottom up. So this is going to be, for sales revenue, our consigned units sold times the unit selling price. In this case, Hester, on our behalf, sold 130 units. As is stated way up in the beginning, each one of these is going to sell for $80 a piece. That is $10,400 worth of sales revenue. Well, we don't get to have all of it because Hester is going to keep a 10% commission. So to figure out their commission expense, we're just going to work our way backwards, take our sales revenue from the transaction, and multiply it by that commission percentage. So if we take 10,400, multiply it by 0.10, 10%, that means that Hester is keeping $1,040 from themselves, which means we get the remaining 90%, which, because our debits equal our credits, has to equal $9,360. And we can figure that out also, by taking our sales revenue from the transaction and multiplying it by 1 minus the commission percentage. If you wanted to do it that way, it also works. Prove it to you. We'll take the 10,400 and multiply it by 1 minus the commission percentage of 10%. It comes out to be $9,360. So we recorded our consigned revenues on these controllers for the period. Recorded consigned revenues. But the sale still occurred, and that gap matching principle says whenever we record revenues, we have to record the expense in the same period that it helped us earn those revenues, which means we need to record our primary expense, which is our cost of goods sold. And cost of goods sold, like always, is recorded at our basis. So we're going to take our consigned units sold and multiply it by our basis per unit. How much did it cost FunCon to manufacture those 130 controllers that Hester Consignment sold on our behalf during the period? Well, we paid $50 a piece to manufacture them, so those 130 controllers cost us $6,500. We need to take that inventory off our books. What account am I going to take it from? We already took it out of finished goods. It was sitting in consigned inventory. Well, it's no longer consigned because it's gone. It's in the hand of the customers. It's sold. We need to reduce this on our books by crediting consigned inventory for $6,500. And here we recorded COGS on this sale. Moving on to September. On September 30th, on 9/30, Hester is going to sell another 90 controllers on our behalf during the month of September and inform us as such. What's our entry going to look like? Our entry is going to be, account-wise, the same exact entry that we had above. It's going to be a debit to due from consignee for our portion of the sales that are being generated. It's going to be a debit to commission expense for our consignee's portion, which is Hester's 10%. And we're going to record sales revenue for the whole amount. We're going to use the same formula that we had above. Consigned units sold times unit selling price gives us our sales revenue. Well, they're selling 90 units on our behalf. They're selling them, again, way up here, at a rate of $80 per unit. So if they're selling 90 units at $80 a piece, we just multiply those two numbers together. We come up with $7,200 worth of sales revenue from these consigned units that Hester's selling. Sales revenue from the transaction times the commission percentage. Well, Hester gets to keep 10% of that, so 10% of 7,200 is $720, which means us, FunCon, gets the difference. 7,200 minus 720 means that Hester is now obligated to send us the remaining $6,480 when we recorded our consigned revenues for September. Then also on September 30th, we got to record the expense. And again, that entry is going to be the same thing as above. It's always cost of goods sold over consigned inventory. And we're going to find it the same exact way we did above. It's our consigned units sold in terms of quantity times our basis. And our basis is $50 per unit. Again, you have that information here. Each controller costs $50 to manufacture, which means FunCon paid $50 a piece for those 90 units, or a total of $4,500 to manufacture those goods in the first place. now in our journal entry, we're going to one more time denote the fact that we recorded COGS on this sale. October 31st, we got another one of these guys to record. Well, during the month of October, Hester Consignment is selling another 7 of these controllers on our behalf. Sales are slowing down a little bit, but they're still moving units. Journal entry is the same. It is a debit to due from consignee, a debit to commission expense, and a credit to sales revenue. Figured out with the same math. Sales revenue is going to be our consigned units sold times the $80 per unit selling price. So those 70 units that we are recording have been sold on our behalf, are being sold at $80 a piece. That's $5,600. Hester's take on this is 10% of the selling price, so they're going to get to keep $560, and they're now obligated to send us the remaining $5,040. And here we recorded one more time our consigned revenues. One more time, let's record the expense on Halloween. Still the same setup. It is a debit to cost of goods sold over a credit to consigned inventory, found by taking the number of units that have been sold on our behalf and multiplying them by our basis. And our basis on these units throughout this whole problem has been $50. That's how much we spend to manufacture each one of these, which means that Hester gets to recognize $3,500 worth of cost of goods sold during the period and reduce their consigned inventory by that same amount when, one last time, they recorded their COGS on sale. So now down here we have Hester Consignment, which is going to remit payment for the controllers sold and return unused controllers to FunCon. At the beginning of this, we said that they are going to transfer payment when either every last controller has been sold or when 3 months have passed. Well, they sold 70 here. They sold 90 here. That's 160. They sold 130 here. That's 290 controllers, which have been sold at this time. Well, that's not the 400 that we consigned with them in the first place, but it doesn't matter because the 3 months have passed, which means they still have 110 controllers in their wares. So on November 1st, we're firstly going to receive the cash that is owed to us from Hester Consignment. We're also going to have to put any unsold units which were consigned back in our inventory, because they're no longer going to be consigned inventory because our consignee is sending them back to us. We're going to put that back on our books. We're going to increase our finished goods inventory account by the value of the goods being returned to us. We're going to have to take that receivable off of our books, our due from consignee, because Hester is paying us actual cash. And we're going to have to reduce our consigned inventory by the amount of controllers at their basis that Hester was holding on to when the 3-month end came to this. It says here that Hester is paying the shipping expense, so we don't have to worry about putting that on the books. Let's just worry about what we're going to receive. Well, how much money does Hester owe us right now? The amount of cash that we're receiving should be equal to the amount that was due to us. So actually I'm going to start with this credit to due from consignee. What was the balance of that account at this time? Well, here we increased it by $9,360. In September, we increased it by another $6,480. And then during October, we increased it by another $5,040. So at the time that we're recording this entry on November 1st, the balance of our T account for due from consignee will be $20,880 on our books. Well, if they're paying off their debt to us, that means that we are going to receive that $20,880. We ran the numbers earlier to figure out how many controllers they still had in their possession when our contract ended. Well, I'll do it one more time. They sold 130. Plus 90 is 220. Plus 70 is 290. They sold 290 of the 400 controllers that we consigned, which means they have 110 of those left. Well, For this, we can just figure out how much has got to come out of consigned inventory by looking at the balance of the T account, but you can also figure it out mathematically by taking your remaining consigned inventory and multiplying it by your cost basis per unit. So those $50 controller at their cost basis that Hester still has, and 110 of them, means that they would have $5,500 worth of our inventory that they're returning to us at that time, and we're going to move that $5,500 out of consigned inventory and put it into our finished goods inventory account. And to record on this journal entry what happened, we're going to say that we received payment from Hester and the return of unsold inventory. So, how much cash in this case did we receive from Hester? Well, we received $20,800. What was Hester's total commission expense during the period? Let's go and add this up. We had a commission expense that we recorded on our books because Hester sold our stuff on August 31st of $1,040. For the inventory they sold during September, it was $720. And for the inventory that they sold during October, it was $560. So they got a total of $2,320 that was their take on selling this inventory on our behalf. And we got to keep the other $20,880. Well, what happens when you add those two numbers together? We get $23,200. Is there a way that number should make sense? Well, let's think about this. They sold, as we've gone through, 290 controllers on our behalf. And they sold all of them at $80 a piece. So if we took the number of consigned units sold and multiplied it by the unit selling price, the $80 a piece, that should be the balance of our sales revenue account, which should be the total amount of sales that occurred from this relationship that we had with Hester. Well, 290 times 80 is indeed $23,200. So we have every single dollar accounted for.